This is our first multi-manager Nedgroup Investments Investment Insights session for 2022. It promises to be a great next 2 hours. It's certainly our intention to keep to our time, so we're wanting to aim to finish at 12 o'clock, and we have a great lineup of speakers for everybody. So welcome, and let's get cracking. In terms of the agenda today, we're really covering, I think, some key topics that are highly relevant at this point. We're looking and starting off the morning with a look at South African asset classes and what are the future expected returns across equities, bonds, cash and property. We then have Nikki Weimar, Nedbank's chief economist, speaking about the South African economy and specifically the effects of the changing global environment and how that is playing out in South Africa. We cross over to a Goldman Sachs speaker, and she will be speaking about really the Russian-Ukraine conflict that is happening at the moment and the effect that this is happening all over the world and really on global markets and how that's playing out. We then go to global equities. From a global equity perspective, we'll be focusing on quality global stocks. They've been performing strongly over the last 5 years or so. They've had a recent dip, and do we look and feel that they are the next best bet to move into in the whole debate about growth versus value, quality versus emerging markets? And then lastly, really one of my favorite Sunday Times journalists that I look forward to reading every week, Professor William Gumede, who will be looking at South African politics and specifically at the ANC, the changing landscape in South African politics. And we know in December this year is the ANC elections for their new leaders and leadership top 6. So a great lineup of speakers. I think before we really get going and just to set the scene, let's take a look at what's been happening in markets, both South Africa and globally. And I've got up here on the screen the returns hot off the press up until Friday last week, the 11th of March. And on the top part of the slide, you will see South African returns across South African asset classes, equities, properties, bonds, and cash. And then on the very bottom, US dollar returns for global markets. And in the middle are the global markets represented in South African rands. So let's just keep everything in rands and look at the top and the middle portion. So from a South African perspective, over 1 year, we see that all asset classes have done reasonably well. Equities are up about 10%, property up 14%, and bonds have also way outperformed cash, giving you 10% return relative to cash of around 3.5% to 4%. Globally, we see a slightly different picture. Global equities in rand terms are flat for the year. Property is up 10%, and as expected with rising interest rates on the forecast, we see global bonds on negative 6% in rands. Cash is about flat. So interesting enough, over the last 12 months, the South African rand has actually been very stable and constant, and you can see that reflecting between very similar US dollar figures to South African rand figures. If we look at the year-to-date figures, those ones I think are particularly interesting and of course take into account the recent turmoil that we've been seeing across Europe with the Russian-Ukraine conflict. And I think the key one to point out here is the equity returns. So if we look at South African equity returns year to date, we're up about 2% or so in terms of the SWIX index. Interesting on the global scale, in rands, MSCI All Country World Index is down 17%. So we see nearly a 20% differential between the returns one has achieved on South African equities versus global equities year to date. How have markets performed and recovered post-COVID? We all seem to forget that COVID was around. Literally, we were in the heat of it this time 2 years ago. So on the 19th of March 2020, so literally 2 years, virtually to the day ago, the markets were at an all-time low and had just crashed 32% in US dollars and 33% the South African market in South African rands. And you'll see that in the dip of the market. Here we're showing the South African market on the left over the last 2.5 years or so. On the right is the world index in US dollars. The South African market, as we can see, sitting at Friday last week on the 11th of March, has made a massively strong recovery and is up 108% since the low of the market of COVID in March 2020. Global markets also made an extremely strong recovery, and as at the 4th of January this year, global markets were also up, ironically, 108% in US dollar terms from the low that they hit on the 23rd of March. What you'll see is quite a strong pullback in the last month or two, given the conflict and turmoil in Russia, Ukraine, and global markets are now up 83% post the low of COVID in March 2000. Just some of the things that we as Nedgroup Investments multi-manager are currently thinking about and top of mind in terms of when we're managing our funds and looking at things from an investment perspective. So if we start off, first of all, on a global scale, of course, globally, what is really dominating the headlines is the Ukraine-Russian conflict. And that has a whole number of knockdown effects. So, of course, the biggest effect that we've seen is that the price of oil has shot up. I was looking that just 18 months ago, oil hit a low of around about $20 a barrel. It's now close to $130, $140 a barrel, depending on what time of the day you really look at it. So oil prices have gone up dramatically in the last 3 months. That has a knock-on effect in terms of energy prices, petrol prices, and this is ultimately all going to feed into a rise in inflation coming through a rise at the petrol pump when people go and fill up their cars, or you go to the shops and you buy wheat or maize and other products that have really been affected by the conflict. So higher food prices, higher energy prices, inflation. That then has a ripple-down effect into the central bank's behavior across the world, really. So we know that inflation was already beginning to slowly tick up. And central banks in the US and Europe had announced that they were going to start slowly increasing interest rates and reducing their quantitative easing. The effect of the Ukraine crisis could work both ways. It's having an inflationary effect in the world, thereby increasing the pace of inflation, and that might have risks on the central banks wanting to raise rates even quicker than what they had anticipated. But likewise, it's also going to affect global economic growth. And it will probably have a slowdown in global economic growth. And in that sense, central banks will want to keep interest rates a bit lower for longer. So it's going to be interesting to see how it all plays out in terms of whether the current conflict and inflationary pressures actually lead to a speeding up of interest rate hikes or a slight slowing down of them. Of course, asset class valuations are also very important, and we are watching those closely. As per my previous graph, you saw that global markets have actually pulled back close to 20% in the last month or so. And from a valuation perspective, certain pockets of global equities are starting to look attractive. Domestically, similar issues are taking place. Of course, South Africa is just coming out of COVID crisis. The economy from about 3-4 months ago has been opening up. We've lifted the restrictions, and we do see a nice increase in economic activity happening. Of course, with inflation coming now and all the pressures I've just spoken about, this may also have a dampening effect on the South African economy. The other key thing is the South African politics. This year, it's the ANC elections in December, where they choose their big six leaders, the next ANC presidential term, and that, of course, has big effects in terms of South Africa and the political landscape. We just had President Ramaphosa announce the new Chief Justice, Raymond Zondo, perhaps controversially above Justice Meyer, who was appointed as the deputy, but perhaps a lost chance in terms of appointing the first female Chief Justice within South Africa. Finally, just for people who may be interested in terms of our portfolios, what has been the Russian exposure? So if we look at our various multi-manager funds that we manage, in terms of the whole range of funds, before the conflict started, across our portfolios, we had somewhere between 0.5 and 1.5% direct Russian exposure. As we know, the Russian markets have fallen heavily, and most of these investments have actually been written down to zero in many cases. From a global perspective, we've seen a massive move by the European community implementing sanctions against Russia, and they're also removing Russia from most of the large major global indices. So we're going to see Russia taken out of those indices, and going forward, very little investments and capital flows going into the Russian stock exchange. The other key change that's really happened in the last few weeks was the announcement by our Minister of Finance to a change in the offshore regulation that affects the South African unit trust industry. So just to remind everybody, up until a few weeks ago, South African unit trusts could invest up to 30% directly offshore and a further 10% into Africa. They changed that regulation and have announced that South African unit trusts are now able to invest up to 45% directly offshore or Africa. So they've combined those two, and you have the ability to go to 45%. So I know this is now on top of mind of many fund managers across the country who within their portfolios are trying to make the decision of where to go with the amount of offshore exposure within their portfolios. I think we're going to see gradually an increase in the net offshore exposure across portfolios. Global exposure is the best way to really reduce the volatility within a portfolio, to diversify risk. But importantly, you still have to take current valuations, we feel, into account when looking to time when do you want to take that increased offshore exposure. So we within our funds are currently looking at that. We're looking at valuations, we're looking at the rand-dollar exchange rate, and we think we will increase our offshore exposure, but probably slower because of current valuations. We prefer South African equities to global equities at this point in time, but we do feel over time, when appropriate, we will be increasing our global offshore exposure. So those are really, I think, the things that are currently on topic with us, on top of our minds, and hopefully sets the scene a little bit for the rest of today's presentations. So that's all that I really wanted to say. And now I'm going to hand over to our first speaker, who is from Coronation. She's one of the fund managers there, Pallavi Ambakar, and it's great to have her here today. And she's going to really be focusing on South African asset classes and giving us Coronation's view on how they see these and the future expected returns. So I hand over to you, Pallavi.